Hey everyone. Given the broad stock market rally in 2024, it's been hard to find undervalued growth stocks that are still down significantly off their highs. But DigitalOcean stock is still down 74% off its high, despite having a relatively strong year in 2024. The company recently announced quarterly financial results that reiterated my confidence in this stock. So I'm going to share with you those latest quarterly results to highlight the reasons why I like this stock for long-term investors.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So as I was talking about, DigitalOcean's holding stock is down 74% off the high. The majority of that drawdown came in late 2021 and in 2022 when the price absolutely collapsed. And since then, it's been flat to up a little bit. Now, the company's mission is to simplify cloud computing and mostly for smaller businesses, those with fewer than 500 employees. It makes it easier and it's less costly on a monthly basis for those businesses to employ DigitalOcean rather than some of the larger cloud providers. In the latest quarter, the company reported $192 million in revenue, which was up 13% year over year. The company's adjusted EBITDA margin, which stands for earnings before interest, taxes, depreciation, and amortization, came in at 42%, which is down 1% from the same quarter last year. But an EBITDA margin of 42% is really strong. So a drawdown of just 1% is not alarming for a company that has such high margins. Additionally, the average revenue per customer increased by 9% to $99.45, up from $90.84. This is important because DigitalOcean is still in the phase of growing to new customers. And if you're adding new customers and you're increasing the average revenue per user, you're getting two-sided growth, which is really positive for the top line. So looking at the total addressable market for DigitalOcean, it forecasts a $213 billion market opportunity by 2027. In 2024, it estimates the total market opportunity of $114 billion. Now, I categorize this as a small to medium sized market opportunity. Some other industries like, let's say, home improvement, that's a $1 trillion industry. Advertising is another $1 trillion industry. Travel is a $1.5 trillion industry. So those are some larger industries and larger total market opportunities. DigitalOcean doesn't operate in that large market opportunity. And what that means for investors is the upside might be more limited than a company that's operating in those bigger markets, but it also means less competition because when you're operating in a smaller market, you're not attracting that many new participants. You're not attracting that many bigger competitors because they look at this market opportunity and they say, well, let's leave that for the smaller companies. It's not worthwhile for us to go after this kind of a market. So at $200 billion, though, you're kind of in that midpoint between small and medium-sized market opportunity. Now, one of the metrics I look at for DigitalOcean is the net dollar retention rate, and that's been improving from 96% in the fourth quarter of 2023 to 97% in the first quarter of 2024. The net dollar retention rate measures how much an existing customer spends with you in their second year of service. That means if you've had a customer and in the first year they spent $100 and in the second year they spent $100, that would mean a net revenue retention rate of 100%. If the net revenue retention rate is increasing, it usually means that you're offering such good value to that customer that they're increasing their spending with you. Because otherwise, why would they increase their spending? They see the value that you provide and they say, this is a good value. I want to increase how much I spend with you. So a net revenue retention rate of 97% means DigitalOcean's customers spent $3 less this year or 3% less this year than they did the previous year. A slight decrease, but it's good news that it's improving. Looking ahead, DigitalOcean is forecasting 760 to 775 million in revenue, or I should say this is what they were forecasting just a few months ago as of May 10th. Following these results, they upgraded their outlook to 770 and 775 million. So they looked at their results so far year to date in 2024, and they said, you know what, we don't think our revenue will be as low as 760. So they increased it to at least 770 million. Furthermore, they increased their EBITDA margin expectations from a midpoint of 37% to a midpoint of 38%. They also increased their earnings per share outlook from a midpoint of $1.63 to a midpoint of $1.65. However, they did lower their free cash flow margin expectations to 16% at the midpoint, down from 20% at the midpoint. So for most important metrics, DigitalOcean has upgraded their outlook for 2024, and they've already demonstrated good profitability and good cash flow margins for a business that's still growing. It's still in growth mode, and it's still relatively small. As you can see, less than $1 billion in annualized revenue for a market that's upwards of 100 billion as of this year, and then growing to over 200 billion in a couple of years. So they're still a small player in a bigger market, and they're growing. So you can see they have a long runway for continued growth. Finally, DigitalOcean Holdings stock is trading at a relatively cheap valuation. A forward price to earnings of 17.62 is cheap for a company that's growing at the rate that DigitalOcean Holdings is growing, generating the profit margins and cash flow margins that it's generating, with a market that's also growing at a compound annual rate of over 20%. All of that signals a good value for long-term investors. So for all those reasons, I like DigitalOcean Holdings stock. And you can see here, if I update my recommendation, you can see I last updated it on June 6th, where I had DigitalOcean Holdings stock rated as a buy. June 21st, when I had DigitalOcean Holdings stock rated as a buy. And I'll update that recommendation here today on August 12th. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.